Welcome to the Pensions and Lifetime Savings Academy webinar. My name is Frances Corbett and I'm head of the PLSA Academy. I'm delighted to introduce Kempen, our sponsor, and to Jeff Neate, Head of Client Portfolio Management at Kempen, who's going to be our subject expert for today. This is the third webinar we've held on the subject of fiduciary management. Today, we will look at both the selection process and the transition, as well as business as usual support for trustees once they've appointed their manager. I'm going to hand you over now to Nick Clapp, Head of Business Development at Kempen, who's going to take you through what we're covering today and also to tell you a little bit about Kempen, our sponsor.
Thank you, Frances. On the previous two webinars, which are both available on the PLSA website, we covered off a number of topics. Firstly, the origins of fiduciary management and how it's evolved in the UK. Secondly, the growth of fiduciary management and how 1 in 8 schemes in the UK now uses a fiduciary management model, and with growth around 25% per annum shows no signs of slowing down. Thirdly, cost transparency and how this is an area that is coming under increasing scrutiny from both the FCA and more recently from the CMA. Fourthly, the different sorts of fiduciary management, how it's not a one-size-fits-all approach. And lastly, how independent oversight can really help. Before we start, a few words on Kempen, who we are. Kempen is a long-established merchant bank specialising in asset management, securities broking and corporate finance. We're also one of the early pioneers of fiduciary management, and it accounts for about 70% of our business and 45 billion assets under management. We've been providing fiduciary management services since 2004 and have a range of clients in size from 50 million to several billion. Today, we're going to cover off 3 areas. Firstly, selection process and what best practice looks like. Secondly, some considerations for transition. And thirdly, business as usual and what that looks like and feels like from a trustee's perspective. So let's get started with the selection process, an area that's come under increased scrutiny due to the lack of due diligence over recent years. However, there is some good news that this is improving.
When looking at the selection process, let's make the assumption that the trustee and the sponsor are in agreement to look at fiduciary management in more detail and to understand what different providers can offer. By this point, you might even have met 1 or 2 fiduciary managers, especially if your current investment advisor offers those services. Firstly, what should best practice look like? Well, in a nutshell, best practice means seeking independent help to guide you through the selection process and then seeking independent oversight on an ongoing basis. And why are we discussing this? Well, because best practice isn't always being adopted by schemes. That's a concern which has been highlighted by the FCA and by the Competition and Markets authorities in recent reviews of the market. Indeed, some schemes have moved from advisory to fiduciary management services with the same provider without any independent or competitive process to establish that that provider is the best match for that scheme's needs.
So what is the value in getting independent oversight?
The benefit of appointing an expert to help you with the selection process is that it makes sure you end up with the right outcome for your scheme and your specific requirements. You might have got there on your own, but I certainly have come across a number of schemes where they didn't seek independent help, and they either did it themselves or just went with the easiest option, and now they're not happy with the decision that they took for various reasons. It's important to get this help because fiduciary management isn't homogeneous. Our approach to fiduciary management is quite different from some of the consultants and different again from some of the big asset managers. And it's really important not only to understand those differences, but to understand what your preferences and needs as a trustee group are.
One of our clients recently went through this process, so let's hear from Mira and the MENCAP pension plan had to say about their selection process.
The MENCAP pension plan adopted fiduciary management back in 2012. Since then, the fiduciary management landscape has changed with a lot more providers in the market. So in their review this time around, the trustees felt it's important to have an organisation that knew the market inside out and the capabilities of the providers to support them. In addition, they felt that having an independent person helping them throughout the process would help them to get to the right outcome. So in terms of preparation, since 2012, again, a number of trustees had changed in the board, and the personnel on the sponsor side had also changed. So one of the first things the trustees did was to review whether fiduciary management is the right thing for the plan. And once that was done, they, together with the sponsor, then went on to agree their investment beliefs. And then just before the process started, they also had some training to fully understand the fiduciary management landscape.
Just as there are different types of fiduciary managers, there are different types of selection consultants who are able to help you. Broadly, they can be grouped into the accountancy firms, the consultancy firms, the procurement firms, and lastly, the specialists. The accountancy firms and the consultancy firms are quite similar in so much as they have investment consulting expertise, but they don't themselves offer fiduciary management solutions. There are consultancy firms that have decided to provide fiduciary management services, but they don't also provide the independent selection advice due to the inherent conflict of interest. There's usually a lot of detailed due diligence that you have to undertake on fiduciary managers on a regular basis to take that selection role. The procurement firms tend to be less strong on the investment side, but they do have strong governance skills and a background in helping trustees negotiate and select providers across the range of services that they provide. Lastly, the specialists, well, they do just that. They specialise, they focus on one thing, which for them is fiduciary manager selection exercises. And just like us, they tend not to be a household name, but they've got a real specialism in the space that they operate. One aspect that always holds true is that you can flex the level of due diligence in relation to the scale of the issue. So a scheme of 20 million in assets is unlikely to go through the same type of extensive due diligence that a £2 billion scheme would. And I'd suggest a common sense approach is used to work out where you fit on that spectrum.
This looks like it's coming with a significant price tag, Jeff.
Well, the cost of a selection exercise are typically not that material in the grand scheme of things, and they can be offset, or more than offset, by the lower costs that you get with fiduciary management. The cost of fiduciary management has been reducing steadily in the UK since it was introduced over 10 years ago. And I reckon that the costs for fiduciary management, once you think about the total asset management fees across all the providers, well, they're now at parity or even lower than you would get with a traditional consulting model, despite that extra layer of governance. And you have to include in that equation the selection and independent oversight. It might not feel that way at the point that you actually write out the cheque to the selection firm, but that investment will pay dividends in the long term. However, it is important to make sure you're comparing apples with apples when it comes to the total cost of the services, work out what's included, what isn't in the different fees that you're quoted.
So having made the big decision on your fiduciary manager, there are still a few items to address. However, much of the heavy lifting in this transition process will be done by the fiduciary manager.
Indeed, Nick. But it is important that trustees realise there's still a requirement for them to invest some time and resources during this onboarding process. That in turn will make sure that the appointment is successful and achieves its goals. There are really three main components to this transition phase. Firstly, the onboarding of the scheme to the fiduciary manager's platform. Secondly, introducing a new investment strategy. And thirdly, transitioning the assets from the current investment advisor or fiduciary manager. It's important to note that these three items might not happen one after the other. They might happen concurrently. Indeed, it might be more efficient to take the transition with a new strategy in mind.
Now, I understand transitioning assets from an investment consultant to a fiduciary manager, but when you say from a fiduciary manager, what do you mean?
Well, we are starting to see some of the early adopters go to market and re-tender fiduciary management services that they require. In other words, we're starting to see fiduciary management clients move from one fiduciary manager to another. And that's principally down to the evolution of the UK market. It's changed at quite a pace. So the early adopters might now realise that there are different options open to them. And also trustees are now better informed buyers, and they realise that this isn't a one-size-fits-all solution. There's a lot of variation within the fiduciary management market. So let's focus on the onboarding process first of all. That's really critical because the legal agreements that you sign during this period effectively form the template for the relationship going forward. Prior to the selection process and during it, you'll have gained a greater degree of certainty on the type of fiduciary manager you're looking for, so you should have the big items tied down, but this is the opportunity to get into the detail and agree the exact areas of responsibility between the trustee and the fiduciary manager. Your fiduciary manager will have standard documentation reflecting the services they provide, but it's important for you to be able to ensure that the agreement reflects your own needs and it's customised where necessary. And tying back to the first topic, this is an area where the independent selection consultant really can help, because they'll allow the trustees to navigate more easily through these kind of issues.
So let's hear from Neate on how they tied down these services and the level of involvement that they had in that process.
The service that we were going to receive was very key to the trustees. So right throughout the selection process, we focused on this. Once Kempen was appointed, we had a series of meetings with them to hone it down, because we wanted everything to be set out clearly and the fees to be transparent, and we were able to influence the final document and the schedules. In terms of the transition, I was involved initially to make sure all the parties were informed of the appointment, as well as getting all the documentation signed. Once that was done, Kempen did all of the work in relation to the transition. I got involved just in providing background information and other documents that they needed on an ad hoc basis. It took us some time to set up the custodian agreement and also to cross the T's and dot the I's in the investment management agreement. And so it's important to note that this takes time. We also had weekly meetings to keep abreast of progress.
Now, I'm sure you'll agree with me that getting the legal agreement right is important, and that you should take the time that's necessary to do that. The only problem with that is that until you've got that legal agreement in place, the fiduciary manager doesn't have what's called a power of attorney, which means until they've got that, they can't act on your behalf. They can't start all the practical work, the operational work about actually transitioning the assets. And we do have a way around that, which we recommend to clients, which is to, at the start of the process, sign a temporary power of attorney. That allows us to lay all the groundwork that's necessary for the asset transition in parallel with working out the investment management agreement and getting that signed. And that leads to a faster and a smoother transition.
You mentioned the investment strategy earlier. Why should appointing a fiduciary manager mean that I need to review my investment strategy?
Good question. There are a number of considerations that will have an impact on how and when you implement the change in investment strategy. And it's not necessarily the case that you go through a wholesale change of all the assets at the point of onboarding to the new fiduciary manager. For example, what you might do is to make some of the highest priority changes in the short term, changing the hedging levels, for example, and then take more time to introduce new asset classes and new managers to the trustees, go through trustee education process. With the structure that we have in place, if there are any asset managers that you currently use that you want to retain, we can accommodate that too. Some of our peers don't have an architecture that's that flexible. Now, the last topic that we wanted to touch on is the transitioning of the assets itself. It's a whole topic on its own, really, but perhaps for now a handful of points that are worth bearing in mind. Firstly, consideration needs to be given to the speed and the efficiency of the transition. We advocate a pragmatic approach to transition so that where there's a movement of assets, you keep costs to a minimum. Secondly, size does matter, unfortunately for smaller pension schemes. As a larger scheme, you're likely to have many more options open to you in the transition process. And lastly, having independent oversight can again contribute to the success of that process. As a trustee, that gives you comfort that every aspect of the transition is being carried out by the fiduciary manager fully in your best interests. One of the outputs from this period is for both the trustees and the fiduciary manager to get used to working with each other. That's not something you should underestimate, and it's critical to building trust between the two parties. Overall, from appointment to getting on with business as usual, it might be as little as 3 months for less complex portfolios, and it can be a lot longer. This is a time when the trustee is likely to have to inject extra time into investment-related issues, but time spent here will reap dividends at a later date.
So let's turn to the last item on the agenda. Once the transition and onboarding is complete and immediate changes on the investment strategy have been implemented, all of the parties can get on with what we refer to as business as usual. A frequent question we get asked is, what does this look like? But usually buried in this is a more emotional question, which is, how do I retain control?
Well, let me try and give you a flavour of what this looks like from our client's perspective. And they'd be the first to say that they feel more in control than they ever did before. And the reason for that is that they have a stronger governance function as a result and a trusted partner to help with the execution. That's underpinned by the reporting structure that we put in place. Our reports, as well as having a dashboard with all the key points, have lots of detailed backing information about all the fund managers in one consistent format and on a consistent basis. In the same vein, instead of seeing numerous managers who will talk about the macroeconomic environment in different ways and from different perspectives, you get a consolidated view from us across all asset classes.
So Jeff, often trustees assume that they will spend less time on investments when they have appointed a fiduciary manager. I think what you're saying is that this may not necessarily be the case.
Well, it very much depends on what the trustees are trying to achieve. For some trustee bodies, it's all about saving time. For other trustee bodies, it's about maximising the use of their time on the things that they can make a real difference to.
Okay, so what do you do to help trustees focus on the big picture?
Rather than involving the trustees in decisions on specific managers and presentations from managers after managers, we turn this process on its head. We start at the top, we start at the funding ratio, we start at the objectives, and then from there we drill down. Why has the funding ratio changed? How are we doing in line with the objectives? What's caused the change? And then we drill down to look at what's behind the change in the funding position. Has it been caused by the strategic asset allocation? Have there been changes in the actuarial assumptions? Has the selection of an asset manager contributed to underperformance or outperformance?
So let's look at the final words of wisdom from Mira at Mencap on this topic.
The actual transition took 3 months, so June through to September, and that was also because 20% of our portfolio was in illiquid assets, so we had different notice periods. In the September trustee meeting, Kempen gave us an interim transition report, and then in the December meeting we had a final report. We also had the latest valuation and a funding update. So I think we got to business as usual very quickly. In terms of control, I would say yes, we do have regular dialogue. Again, in the December meeting, we were able to have a session on investments, and we agreed a strategy. Going forward, I would expect Kempen to be providing us the type of reports that the trustees can understand so that they can make the right decisions, monitor progress. So I believe we do have control.
This means that the trustees spend a much larger proportion of their time on these strategic issues where their input can be both important and really make a significant difference. And it's not just investment strategy, there are also policies around responsible investments, use of repos, stock lending. All of that needs to be agreed on by the trustee so that the fiduciary manager can implement these in line with the trustee's wishes. We work alongside our clients to advise them on what each of these elements should look like, reflecting their individual circumstances and their scheme.
Thanks, Jeff, for that. So just to recap on our topics that we've talked about today. We talked about the selection process and the importance of independent oversight. Secondly, we've discussed transition, how this can be broken down into the client agreement, the introduction of a new investment strategy, and lastly, the transition of assets. And thirdly, how business as usual now comes from looking at the funding level and the progression against the investment objectives in the first instance, and then drills down from there.
Thank you to Jeff and Nick and to Kempen for their valued sponsorship of this webinar. And also thank you very much to Mira Mohidin at Mencap for her very valuable input. We are now going to open the session to your questions.